Imagine walking into a store where nothing costs more than $5. No sales, no coupons, just products at prices that seem too good to be true. Now imagine that store generating over $5 billion in revenue every single year. This is Dollarama. The story begins in 1910, when Salim Rossi opened a small variety store on Craig Street in Montreal. For 82 years, the Rossi family ran a modest chain across Quebec. Then in 1992, third-generation retailer Larry Rossi had an idea that would change everything. He transformed one of his stores in Matane, Quebec into something radically simple. Every item cost $1 or less. The concept was an immediate success. Within 2 years, all 44 Rossi stores converted. The first store outside Quebec opened in New Brunswick. By 1994, Dollarama was in Ontario. The real acceleration came in 2001, when Dollarama acquired 60 locations from a failed retail chain. By 2004, Bain Capital bought a majority stake. The company went public in 2009 on the Toronto Stock Exchange. By 2012, 700 stores. By 2015, 1,000. Today, over 1,700. And it is no longer just a Canadian story. Dollarama now owns a controlling stake in Dollar City, operating 741 stores across Latin America. It entered Australia through acquisition. A discount retailer from Quebec now operates on 3 continents. Most people think Dollarama is just a bigger dollar store. That is entirely wrong. Dollarama is a precision-engineered retail machine built on 5 principles that work together like the gears of a Swiss watch. First, direct sourcing. Dollarama buys directly from manufacturers, no distributors, no middlemen. Second, fixed price points at $1, $2, $3, $4, or $5. No sales, no coupons. This simplicity creates efficiency from inventory management to store operations. When you cut out the middleman on billions of units, the margin advantage is enormous. Third, corporate ownership. Every Dollarama store is owned and operated by the company, no franchisees. Complete control over every detail. Fourth, small format, high traffic. The average store is about 10,000 square feet, strategically placed in high traffic plazas with affordable rent, low operating costs, rapid inventory turnover. The result, a 45% gross margin. In discount retail, that number is almost unheard of. Most dollar stores operate on margins in the low 30s. Dollarama generates gross margins comparable to premium specialty retailers while selling products for under $5. Here is the psychological genius behind Dollarama. It is called the treasure hunt effect. Dollarama deliberately rotates its inventory. Products appear, disappear, and reappear unpredictably. When you walk in, you genuinely do not know what you will find. This creates a dopamine hit that keeps people scanning shelves and buying things they did not plan to buy. The treasure hunt only works because of something deeper: trust. Everything is under $5. No tricks, no sales that change the price next week. The trust is so strong the company does not advertise. It never needed to. And here's what most people miss. Dollarama is not a store for poor people. Middle-class families shop there. Professionals shop there. Dollarama built a nationwide habit. During economic downturns, Dollarama thrives. During booms, it still grows. In its most recent quarter, it achieved 5.6% same-store sales growth, while other retailers warned about weakening consumer confidence. Why can no one catch them? With 1,700 stores, the buying volume creates a virtuous cycle that competitors cannot break. Dollar Tree has 260 stores in Canada. Giant Tiger has 260. They cannot match the volume, cannot match the pricing, cannot match the margins, and Dollarama has already secured the best locations in the best plazas across the country. Beyond the obvious, Dollarama has 4 advantages most analysts overlook. 1. The multi-price point strategy. Moving from $1 to $5 unlocked entire new product categories. 2. Logistics mastery. Centralized Montreal hub plus a new Western Canada facility. 3. The Rossi family itself. 4 generations of retail. Neil Rossi grew up in the business. 4th, capital allocation. Dollarama bought back nearly $340 million of its own stock in 1 quarter. No business is invincible. Supply chain costs are rising. Consumer confidence in Canada is weakening. The Australia transformation is a multi-year project with no guarantee of success. Mexico is currently loss-making, and in Canada the question of saturation is real. At 1,700 stores heading to 2,000, how many more can the market absorb? Here are 5 lessons from Dollarama that apply to any business. Lesson 1. Simplicity scales. Remove complexity from every layer. Lesson 2. Own your supply chain. The companies that control their supply win. Lesson 3. Let the product speak. Dollarama spends nothing on advertising. Genuine value is the best marketing. Lesson 4. Compound the boring stuff. Open stores, improve logistics by a few basis points, buy back shares. Lesson 5. Know when to evolve and when to stand still. Change what you must. Protect what matters. In 1992, Larry Rossi opened a store selling everything for $1. Most people thought it would fade away. Instead, it became a $35 billion company. The lesson is not about luck. It is about a business model so well designed it works in small towns and big cities, in boom times and recessions, in Canada and Latin America and Australia. If you can sell something for a few dollars and make people